right, let's wait a couple of minutes to get started. Give everyone enough time to jump on the call. Let's wait one more minute and then begin the seminar or webinar. Alrighty, I think we can get started. So I'm Juuso Turtiainen, an associate at Lexia Attorneys, and I'd like to welcome you to our next edition of the Lexia Growth Academy. Today we'll be going through employee incentives and their implementation and taxation and the current changes that have come into force this year. With me is Frans Bergman, who will be taking you through this topic. You can put your questions within the comments or the Q&A section, and we'll go through them at the end of the presentation. But I guess we could start off with Frans, if you want to tell a little bit about yourself and your background, and then we'll get started.
Yeah, thank you, Juuso, for the introduction. My name is Frans Bergman, and I work here at Lexia Attorneys and in our startup services. And one of my main fields of expertise is taxation, which then naturally is the reason why I'm here to spend this next hour with you here talking about employee incentives, and especially from the taxational point of view, but also about giving you a couple of words about their implementation. But without further ado, let's get into the topic of today. There are, of course, numerous ways to incentivize employees. Some of you are probably familiar with some of these. My intention is by no means to give you an overall or total understanding of all the variations and different methods to incentivize employees, because the topic is so broad and complicated, if you will. But I've rather chosen to focus on some of the things I found interesting and some of the new legislation we have in this field and area. So I've chosen here to focus first on employee share issues, and regarding this we have some interesting legislation that has entered into force just recently, actually from the beginning of this year. So we are operating with such a new legislation, which will hopefully have a positive effect on the way especially startups have the possibility to incentivize their employees. Then I want to give just some quick words about the options. This is of course a wide topic, but I just want to maybe just to give you a piece of thought of what the differences between the employee share issues and options are, and then finally what their differences are to a simple subscription of shares. So I'm just rather here trying to get your interest into this issue and maybe challenge your thinking in what ways to incentivize employees are tax effective in maybe in your company and your case. But before digging deeper into the incentivizing methods, I would like to give you a quick word about valuation of shares, because I think unless you understand how the valuation, and especially the valuation in the tax office, applies, how it functions and works, and what its relevance is, I don't think you can really understand what the differences and advantages of the different incentivizing methods are. So when we operate in the world of taxation, the tax authority always operates with the fair value. So the fair value is the main value of interest in taxation. And as you probably know, the fair value is generally defined as the probable selling price between two independent parties on free markets. That's the most simple definition of fair value. And that's actually the definition the tax office accepts, luckily, in this context. So I can tell you, when we operate, for example, with real estate taxation and the valuation done for real estate tax purposes, the concept of fair value is a lot more complicated, but let's not get deeper into that. Let's just be lucky that we don't have to operate with those kind of interpretations in this context. But then how do we define the fair value for tax purposes? Well, according to the principle the tax authorities accept, we first have to examine whether we have comparable transactions between independent parties that have been conducted recently. So if, for example, companies shares in the same company have been sold recently between two parties with different interests, which are who are independent from each other, then first and foremost we apply the price applied in the said transaction. Normally, and especially when we are valuating unlimited or limited liability companies that are unlisted, so who are not on any market, it's quite rare that we have comparable transactions to utilize. So quite often we have to operate with more kind of theoretical calculations. And the main calculation formula the tax office accepts is one that's based on the net asset value and the yield value. So the tax office do both take into the account what appear on the balance sheet, and then what the financial results of the company has been in historical years. So just to give you a simplified explanation and a short example of this. So first and foremost, we have to figure out the net asset value, and in simple terms, the net asset value will correspond to the equity on the balance sheet from latest financial year. It would be too simple just to apply it as this, which then means that we have quite a lot of exceptions and corrections that are made. The most remarkable of them is the corrections that are made between the fair and tax values of assets. So say we have an asset whose book value and tax value is remarkably lower than their real fair value if sold to an independent party. Then for valuation purposes, we have to revalue this said asset and take it into account when calculating the net asset value. Then when we have figured out the net asset value, we have to calculate a yield value, and the calculation of yield values are done by looking at historical results from the last financial years. So in simple terms, again, we are looking at the results from 3 past years and calculating the net asset value by using a yield rate of 15%. And then finally, when we have the net asset value and the yield value defined as said above, we calculate the fair value by firstly, if the net asset value is higher than the yield value, we can use the net asset value as it is and apply it as the fair value. So that's quite simple. Then in turn, if it turns out that the yield value is higher than the net asset value, which typically is the case, and especially in startup companies or maybe not startup companies, but maybe scale-ups who have already gotten into their journey to become the next unicorn, we often commonly have like it's more of yield based in many cases, in every case. So then we have to, in case the yield value exceeds the net asset value, we calculate an average of these and get the final fair value applied in taxation.
So as a quick comment, should you have any questions, then do put them up in the question and answer box or the chat box, and we can look into the questions after Frans's presentation. And sorry for interrupting, Frans.
Definitely, yeah. And if we look at this then in figures and numbers, so I put just a fictional example to describe this a little bit more, or maybe deepen your understanding in this. So if we in year 3 have a company with an equity of 100 money, and then say on the balance sheet we have an asset, a land plot whose value in the taxation and in the books or in the bookkeeping is 300, but whose fair value is estimated to be 400. Then we have to take this account of 100 into, or take this difference of 100 into account in the valuation, which then would mean that we get the net asset value of 100 plus 400 minus 300. So 200 would be the net asset value in this case. Then we figure out the yield value by looking at the balance sheet from past historical 3 years, and say we have financial results of 60, 120, and 45 in years 1, 2, and 3. Then we calculate an average of these, which would equal 75, and then by using a yield rate of 15%, we get a yield value of 500. Okay, we have a net asset value of 200 and a yield value of 500. Then we realize that the yield value is higher, so we calculate the average of these. So 200 plus 500, which would be 700, and the average of those 350. So 350 would be the in simplified fair value in this fictional case. So now that you understand how the tax office looks at the concept of fair value, I think you understand the meaning and purpose of this new legislation that has entered into force now from 2021 onwards. So the concept of employee share issue has previously already been around, but now the new legislation that has entered into force is actually more of a clarification of the valuation issue, and it's also at the same time has made it possible to apply or subscribe shares below the fair value without any tax effect at all, actually. So the reason to this is that the tax office or the tax authority now, on the basis of the new legislation, can under some circumstances and requirements apply a so-called mathematical value instead of the fair value. And in general, and in the vast majority of cases, the mathematical value tends to be remarkably lower than the fair value, because in practice the mathematical value quite simply correspond to the equity on the balance sheet or actually the equity calculated in the taxation, which then quite commonly correspond to the equity on the balance sheet, and which then doesn't take into account, for example, these valuation differences or future yield expectations. And one of the simpleness with this new legislation and the environment we operate in is that the that the mathematical value doesn't have to be calculated by the company itself, but instead the mathematical value appear on the latest tax decision, so we don't have the uncertainty and risk regarding to valuation related to employee share issues on this new legislation. And prior to this reform, the differences between the subscription price and the fair value of shares that was subscribed at unlisted limited liability companies was always considered as the employee's taxable income. So when subscribing shares to a price under the fair value, you always was considered to get the benefit, which was then taxed as earned wage income by a progressive tax rate, which then quite easily the margin tax in the progressive tax rates goes up to 50, even with incomes that are even a little bit more remarkable than little. And actually, the only exemption that was accepted was that in case the subscription price was offered to the majority of the employees, then in those cases the benefit, so the difference between the fair value and the subscription price, was taxable only to the amount the subscription price was less than 90% of the fair value of the shares. So again, to put this into a simple example, if we had a agreed subscription price of 50, and say we had a fair value of 350, and then a mathematical value of 100, then we always operated with a fair value. So the income was considered 300, 350 minus 50, and then say this the possibility to subscribe shares was offered to the majority of the personnel. We had the possibility to exempt 10% from the tax base, so the taxable amount would be 270. And then again, say the subscriber had a normal wage, so let's assume the tax rate on the progressive tax rate would be 15 in his or her case. Then we'd get a tax of 135. And if we compare now this old legislation, which actually is still in force today and which can be applied if this new employee share issue legislation proves to be unapplicable, but still if we compare the old, if we call it the old legislation with the new one, then from January this year onwards, when these requirements for the new employee share issues are met, then the determination of the taxable amount is based on the mathematical value and not anymore on the fair value. In practice, this then means that self-created goodwill, so future and historical yields and yield expectations are not taken into account as a factor that's increasing the value, and neither do we have to operate with fair values of assets, so we don't have to take differences between fair and tax values into account, but instead we operate with the mathematical value appearing on the tax decision. So then, by applying the same example as previously and this new regulation, if we have the same subscription price of 50, we have say a fair value of 350 and the mathematical value of 100. Then simply by using the mathematical value, we have there an income of, actually we have the income of 50, and then tax with the tax rate of 50%, we have a tax of 50. 25 in this example. So the benefit, if we compare it to this example, 135 and 25, this is of course just a fictional example to show and maybe give you an idea of how remarkable this change and the tax implication of this new legislation can be. But as you know, if something sounds too good to be true, then usually it ain't true. So we of course have some limitations in the applicability of this new legislation. That is quite remarkable then. So first and foremost, the opportunity to subscribe shares must be offered to the majority of the personnel, as was the rule in the old environment regarding employee share issues. So this is not designed to reward like single employees or management or anything, but rather to give the opportunity to the personnel as a whole to subscribe shares. The number of shares offered to each employee can though vary, for example, on depending on the value of the employee's work contribution or such factors, but still the possibility to subscribe shares has to be offered to the majority of the personnel. And then the applicability is limited also in such way that it applies, this legislation applies only on employees and people working in the company, and actually the CEO as well, but not on board members not earning wage. And then further, the intention of the new legislation has not to make it possible for owners to increase their ownership with low tax implications. So it's applicable only on subscribers owning less than 10% of the stock. And then of course, if we after the subscription has been put into practice and the shares have been subscribed, if the employees sell the shares, the taxation is normally taxed according to the capital gains tax, then which is lower than the earned wage tax, which is put into practice with the progressive tax rate. And then if we look at the corporate side of and the implementation of the share issue, so the employee share issue is a directed share issue in the Limited Liability Company Act, which then means that the general meeting has to decide on the issue. The general meeting, though, has the possibility, of course, to authorize the board of directors to decide on the issue, but the decision itself or the authorization always have to be accepted in the general meeting. Then further, the decision must be made with a qualified majority, which then means 2/3 at the general meeting. And further, even the decision requires the weighty financial reason for the company. So, in the word of incentivizing employees, there have or in practice it has proven to be a weighty financial reason according to the Limited Liability Company Act. So regarding this, there's hardly ever a question that the requirements in the from the corporate side would not be met. And then typically these employee share issues are combined with shareholder agreements that specifies the redemption of shares at the end of the employment relationship. So quite commonly, the company is entitled under the certain circumstances to buy the shares back. So we often talk about good lever terms that may be used with this regard. So if now that we have a basic understanding of the employee share issue and the valuation issue, if we compare it to the options that are quite commonly used, and more specifically, of course, we talk about call options. So as probably all of you know, the definition of an option is that it gives the buyer the right but not the obligation to buy an underlying asset at an agreed upon price and date. And on the slide we have the typical life cycle of an option, and from the taxational point of view, it's of course the grant and the exercise, so which are those of essence for the tax implications. And in the taxation, as you probably know, it's the time of exercising the option that is decisive. So when we are granted an option, so we're given the right to buy a share for X euros or X money, we have no tax implication. But then at the moment when we exercise and use this option and actually subscribe the share to a price that's under or lower than the fair value, that's the moment when we have to take the tax implication into account. And the taxable income equals the fair value minus the total subscription price. I've called it here the total subscription price. So it's the price of the option plus the subscription price of the share. And the taxation for employees is put into practice as earned wage income tax. So we are again operating with the harsh progressive tax rate with margin taxes of over 50%. And regarding taxation of options, we have no similar valuation advantages and vice versa, no limitations in applicability as in when we are operating with employee share issues. So again, I like to put the theoretical background into simple examples. So if we have an example again that in year 1 we grant an option of 150, and in year 1 the fair value of the share is 50, regardless, or even though the option is or at grant, as previously mentioned, we have no tax effect regardless of the option or the fair value of the share. And then if we go to year 3 and we exercise the option and subscribe the shares for 150, and the company has clearly become the next unicorn and its value has increased from 50 to 350, so we have a good option here, and we exercise it for 150, then we get a taxable amount of 200 that then taxed with as earned wage income, and here I have assumed we have a margin tax rate of 50%, so we have a tax of 100 for at the year of the exercising of the option. Regarding implementation of options, we are actually dealing with the same type of requirements as for employee share issues. So it's the general meeting that decides on the issue of the options, and the general meeting can of course again then authorize the board of directors for this purpose. The decision again requires a qualified majority of 2/3 and the weighty financial reason as mentioned previously. And options are quite common, and they are, if we compare them to employee share issues, the pros of options is of course that we don't have to deal with the same requirements and restrictions as for those applying for employee share issues mentioned previously. So we can grant options to just the employees we want to grant them for, and who we want to incentivize. And then but then on the other hand, we don't actually get any tax benefits from the option. Okay, we don't have to pay tax at the grant, but then at the exercise the taxation is put into practice with the earned wage income tax, which then quite commonly for most wage earners is or leads to harsh tax implications of 50% or so. So even though options are quite commonly used, I would here at the end maybe want to give you a little piece of thought of how you can maybe compare options with normal share issues. So I would say that specifically in situations when the value is based rather on future yield expectations than on historical final financial results or assets on the balance sheets, the share issue can be preferable to options. So typically, for example, or specifically in startup companies who are just in the beginning of their journey to success, I would like you maybe to think and maybe to question the option that is it from the taxable point of view the best possibility that exists, or can it sometimes be even more clever to just keep it simple and use normal share issue. So if we have a situation where the fair value in year one would be 50 as previously, we would offer the incentivized employee a subscription to the fair value to 50. Then of course we have a taxable income of 0 at the moment of the subscription. And then when we move onwards to year 3 and we again have an increased value of 350, then the incentivized employee of course still has his or her share with its value of 350. So if we compare it to the option, then we can realize that, or I would maybe like you to think a little bit more deeply about that could it be sometimes easier and even especially from the tax point of view to utilize more simple incentivizing methods like the share issue instead of utilizing the options that are so commonly used. So and of course by utilizing normal share issues, we don't have any tax say legal tax exemptions, but we still don't pay any tax under the general tax rules. So these normal share issues can of course be used however the company decides, with of course the requirements stated in the Limited Liability Company Act. So again, we need a general meeting decision or an authorized board of directors who make the decision, and then the weighty financial reason to put this into practice. But that was everything I had to talk about this, and looking forward to your questions, and during this seminar or after it, if you have questions or want to discuss what kind of incentivizing programs you use or intend to use, then I'm glad to answer your questions. But thank you for my part then.
Yeah, we do have a few questions already. Just as a general comment, if you do decide to go forward with a share issuance and are thinking about the possible issues with the share side of, for example, an employee leaving, then of course each employee, if they subscribe to a share, should be tied to a shareholder agreement, whether it's an adherence agreement or a minority shareholder agreement, where you can detail out the good leaver, bad leaver clauses on which then the scrape back of the issued shares can be handled. But yes, we have two questions. The first one being, does the new legislation apply if the shares are used for performance bonus programs? Now, performance bonus programs, I'm assuming we are referring to option-based performance bonuses, and not just payment of bonus in cash. That unfortunately I don't know. Frans, do you have any thoughts on the matter?
Well, we would maybe have to look more deeply into what the performance-based program is, but the general rule still is that it has to be offered to the majority of the employees. So that's actually the only requirement in this regard. So if we offer it to more than 50% of the personnel and under the same conditions, then we have the possibility to apply the new legislation. But of course, the requirements and circumstances under which the subscription or the number of shares that each employee can subscribe, that can of course vary based on the performance of the employees. So if someone is performing better, said person can be entitled to subscribe more shares than those performing less good.
Sure. So then the next question was, how are the changes like additional funding or losses reduction of the value, for example, to be taken into account versus the last confirmed mathematical value by the tax authority?
So losses from previous years, they are not actually in this employee share issue. At least to my knowledge, we are operating with the mathematical value on the tax decision. So we have a quite simple and low risk valuation to utilize, which is one of the big benefits of this new legislation.
Yeah, so it seems that there are a lot of benefits to the new regime as well. But again, I assume that it is dependent on the stage of the startup or scale up company, growth company, where a share issuance itself would be or could be preferable to options, and where sort of the weighing in would be company versus single employee benefit.
Yeah, this always, of course, are depending on the circumstances in the company we are talking about. So I focused mostly on the tax point of view, but of course these incentivizing programs have a lot of different aspects to them that have to be taken into account. But the employee share issue in general, its applicability is quite restricted and limited, but when we have a desire to incentivize the employee as a whole, it's definitely something that I encourage you to take into account and examine it in more detail. Then again, we have maybe the share issue, the normal share issue, and the option side of this presentation are maybe better or easier to apply or better suitable for situations where your intention is to reward only a couple or single employees in the company, and they are maybe like you could say a pair to each other, the option and the share issue, while then the employee share issue under the new legislation is applicable maybe in a little bit of different situations.
Sure. So a continuation on the previous question was, how would additional funding, so the company receiving new funding, be taken into account with regards to the mathematical value?
Well, new funding will then, of course, if it's equity based, it of course has an impact on it's always like the mathematical value is, in simple terms, correspond to the equity on the balance sheet of the last financial year. So of course, if you get funding funding that's equity based, then of course this will have its impact on the equity on the balance sheet, and then as well on the mathematical value. So in that aspect, it of course has its impact on the valuation. But you don't have to take it into account or decide it yourself. But it's on the tax decision then appear how it has been taken into consideration.
So in general, it is a matter of timing with regards to when to take forward an employee share issuance, for example, or an employee option issuance, and its possible effect on the employee taxation side. So possibly before a funding round, it might be, especially if going for a share issuance to key employees, might be preferable in that sense.
Yeah, these are of course case by case situations. So they have to be examined in more detail and with regards to the circumstances in said case. But in general, I would agree with that. Yeah.
Excellent. Are there any more questions? If any, we can wait a minute or two to see if we get any more questions with regards to the subject matter. But if no more questions come in, then you can always send either Frans or myself the question by email, and we can then look into it in more detail and get back to you with a response. Although if it does require a bit more looking into the matter, then we can discuss that separately. But otherwise, it does seem that there are no further questions coming onto the chat or the question box. Okay, now we do have one more question. So can you explain the purpose of setting aside shares for an employee stock option pool and how it differs from the example given before? So a stock option pool is essentially setting aside the shares so that it can be utilized in future to incentivize possible employees. Now, in that sense, the options would be subscribed to already in the first example. In that case, but the stock option pool is in general it is a pool of the shares or the options that will be given to employees. So unfortunately, from my perspective, I don't really understand the question. Frans, do you have maybe you have some insight here?
Yeah, I would. It's of course, or I'd say that I don't really get the core maybe of the question, but the I think the from the tax implications point of view, it's just about it's decisive. It's the moment of the exercise, regardless of using of pools or anything similar to that. So it's when the employee subscribes the share, we compare the fair value with the subscription price. So I would say that a stock option pool, at least to my knowledge, would not have any significance for the tax implications. That's my general feeling, at least. But of course, we might look into it in more detail if you have a specific case you are thinking of.
Yeah. So yeah, as previously said, if you do have any specific case in mind, do reach out to us by email, and we're happy to discuss the matter. But as it seems that we have no further questions, I think we can bring this webinar to a close. Thank you, Frans, for going through the topic and leading us into the interesting world of tax. I know this is a very broad topic and very general responses in that sense, but it is already good to have some insight into how to utilize and implement it with regards to employee incentives. we will be sending out some information regarding future Growth Academy webinars after this webinar, and the slides as well as the presentation will be also shared with you by email, as well as then through the Lexia Growth website. But if there is no further questions or comments, I'd like to thank you all for joining us and see you at the next Growth webinar.
Thank you for my part as well, and see you soon.